Rob Stone, 2 damn phones, Babylon can't crack the code.
Welcome back, I'm Brian and this is B-MoneyTrading. Please excuse my voice, I'm about to lose it. So if I don't do a video tomorrow, then you know why. It may just be a quick update, but we're gonna go through this pretty quick. So I ended the day down 36 cents. We can see that the SPY was very volatile, and basically I was looking to add at this level, but my capital, I didn't want to add on just yet in case we didn't stay above this level right here. So I decided just to stay with what I had and not add on to any of my positions. If I would have, then obviously I'd be up for the day, but I thought it's better to manage my risk as well as just wait and see what the market does, because I didn't want it to break below this level and not have any capital to be able to add on to my positions. And so with that said, we're gonna get into what I'd like to call the meat and potatoes of this video. And this is an article done in September 2018, and it was basically CNBC did it, and there's it's like, I guess, a quick interview on Warren Buffett and Jack Bogle and their formula for success and whatnot. And so we'll just go through this really quick. This just tells you kind of a little bit about, anyhow. It talks about in the long run, there's a high correlation between the stock market and the U.S. economic growth, he said. So regardless, the economic climate, stay the course. Don't let these changes in the market, even the big one like the financial crisis, change your mind, and never be in or out of the market. Always be in at a certain level. If you try to trade in and out of the market, your emotions will defeat you totally. And I think a lot of people can relate to that. You know, we'll just go ahead and move on and talk about it more later. Short-term betting is not a good way to go. And then it goes on talking about Buffett, who runs Berkshire Hathaway, accumulated 89 billion fortune over his career, has always maintained a long-term view when deciding whether or not to invest in a company. And this is basically why he does. He says, nobody buys a farm based on whether they think it's going to rain next year. He said on CNBC's Squawk Box, they buy it because they think it's a good investment over 10 or 20 years. In other words, the Oracle of Omaha looks for companies that will last for decades, not just that are doing well right now. And talk about putting together his portfolio and whatnot. And it says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And basically, part of my strategy is buying good quality companies that I believe are undervalued. And I'm not looking to hold them for 10 or 20 years. I'm doing more of a swing trade strategy. But as we go on and talk more, I have another article that will help you kind of get a better understanding behind my strategy. He says, don't watch the market closely. He advises those worried about their retirement savings at the time. If they're trying to buy and sell stocks and worry when they go down a little bit and they think they should maybe sell them, then when they go up, they're not going to have a very good result. And you know, how many times have you been down on a stock and you said, well, once it gets up, you know, to break even, I'm going to sell. You know, this was just a bad trade. And you hold it for a few days or a week and it goes back up and you break even, or you take a small loss for like $10 or something, you know, and then it just takes off, you know, goes on a run. And basically it beat you down with your own emotions, you know, behind it, because you didn't stay the course, you didn't keep a level head, you didn't stick to your plan. And, you know, as we go on, we'll just talk more about it here in a sec. So this is on Forbes magazine about Tony Robbins. He shares the strategies of the world's best investors. Even though we're not looking to invest you could call swing trading kind of like short-term investing. It's not day trading. And Ray Ray Dalio, as well as Paul Tudor Jones. Those are two of one of the two traders or investors that I like a lot, as well as their knowledge for the market and everything I admire. And so anyhow, we're gonna go ahead and move on with this. So basically, Robbins talks about the 4 things that all of them had in common, and he's talking about legendary investors like Ray Dalio, Warren Buffett, Carl Icahn, and what's his name, Paul Tudor Jones. It mentions him up top. Anyhow, it says the 4 things that they all of them had in common. The first one sounds basic, but it's a mistake that the average investor makes. Most investors are focused on most investors are focused on how to make money. The smartest financial minds in the world universally want to make money, but their first focus is on how to not lose money. And that's one of the things I commonly tell y'all about managing risk, and your ability your success is going to be dependent upon your ability to manage risk and mitigate your risk. So this gives you a quick explanation. If you lose 50% of your money, how much money do you need to get back to break even? Most people would say 50%, but it's not true. If you lose 50% of 100 grand, you've got 50,000. A 50% return of that would leave you with only 75,000. You need to make 100% of your 50,000, and that could take years. So basically, break even, you need to make 100% from your 50,000. The best investors know that they're going to be wrong. Unlike the talking heads who say, "I know for sure what's going to happen," the best investors say, "I don't know exactly what's going to happen. I know what I believe is going to happen. I know for sure I'm going to be wrong at some point, so I need to protect myself through asset allocation. Even if I'm wrong, I will still do well." So basically saying, I'll still do well even if I'm wrong, because I diversified and allocated my assets, diversified my portfolio, then I'm still going to do good, because I can be wrong on a few of them and still do good on the others, and my risk to reward. And it goes into more, I'm kind of skipping ahead, but so it goes into this. It says so we'll still do well through asset allocation. The second thing is that they're all obsessed with asymmetrical risk reward. Most people think these billionaires took gigantic risks, but when you actually study the best investors, that's not how they operate. They take on the least risk possible for the highest possible return. Billionaire hedge fund Paul Tudor Jones wants to risk $1 to make $5. He knows he's not going to be right all of the time, but if he risks $1, he'll be fine. If he risks another $1, he'll be fine. And when he makes $5, he's in incredible shape. He can be wrong 4 out of 5 times and still be okay. And as I'm talking about, that I can be wrong on X amount of trades, but if my risk reward's good and I'm allocating and diversifying my portfolio, then I'm still going to be okay. And for example, that trade I did a week or two ago on and I took a loss on it. I was up $50 in the trade. I had small position, and but I was up like $2 and some change per share, and they came out after hours with news of a secondary offering, and so in pre-market I was down, and so I ended up just taking like $17. It was like about $20. But then I was able to take another trade. I sold my other trades, but I took another trade after that, and it was in USO, and ended up making that money back plus then some. And that's basically how it goes. And then shortly after that, I think a week later, I sold 6 out of my 10 positions. I sold 6 for profit, and held the other 4. I was in profit on one of the 4 that I was holding, but excuse me, but it didn't reach the point that I wanted to sell, and so I held on, and eventually I think I did sell. And so anyhow, I started my accumulation process over again, and now I'm in the trades I'm in now. We're gonna go ahead and move on. So when it comes to investing, the best investors, number one question is, what's the downside? What are they risking, basically? What's my risk? That's what I need to know first. Okay, and based on my risk, okay, then if that's what my risk is, whatever it is, then the reward better be good. You know, it better be at least, you know, this or that. You know what I mean? And so finally, they don't put all their eggs in one basket. They look at asset allocation as a science. They diversify across all asset classes within an asset class. Sorry, let me reread that. They diversify across asset classes and within asset classes. They wanted diversification across markets and economies and across time. And so, you know, it's basically pretty self-explanatory that they want to diversify across markets and economies and across time. You know, some of the trades I take are short-term trades. You know, they might last a few days. Some will last a few weeks, and some will last a few months. And then, you know, like I'm holding ACB and CGC. Those I intend will be probably the longer term trades out of all the trades I have right now. Those will be the longest, and that's my intention behind them and why I'm in them. And I slowly accumulate them, but I don't want them making up too much of my portfolio at one time. And so as my portfolio grows, then I'll add on to them, if that makes sense. So with that said, you know, basically, you know, the volatility of the market, I was still able to come out at about break even after today because, you know, I'm holding decent share sizes, and, you know, a few different stocks. You know, I have oil, marijuana, Carvana, TQQ, Constellation, JP Morgan. So I'm holding a few different types of stocks. You know, I don't have like all my assets, you know, wrapped up in FANG stocks or marijuana stocks or bank stocks. Or, you know what I mean? Like I'm hitting different sectors, and ultimately, you know, I continue to add onto my positions at certain levels. And that's the whole point, like we were reading, that it's not about being in and out or whatever, but just making sure to be in at certain levels. You always want to be in at certain levels. And so, you know, as my portfolio grows, I'll look to possibly trade with a base position and then swing shares, you know, off of that position. And I know that probably didn't make a whole lot of sense right now, especially if you're new, but that's something maybe I'll do a video on once I get to feeling better and my voice is doing a lot better and I'm getting over whatever crud I have. So with that said, I'm gonna go ahead and wrap it up. But you know, you just gotta think big. You know, you see these people that, you know, are doing these day trading and they're starting with these small accounts and they just keep them small and it just stays like, you know, 300, 500, 1,000. And then they basically take, you know, try to do these day trades on a broker that's, you know, like Robinhood, basically trying to day trade on Robinhood when you can only do 3 day trades per week on a 5-day period, unless you're over the PDT rule here in the US, 25K. And so for one, you got that going against you, and on top of that, you have a small account, so you're trying to day trade. So I hope you're not dumping your whole account into one position, but you'll find that a lot amongst new traders that you know, they swing for the fences, and when you're swinging for the fences, a majority of the time you're going to strike out, but you're more likely to get on base, you know, with just a small base hit. You know, well, these positions, some of my trades, you know, I'm gonna only make 25 bucks off one of my trades. You know, I might make 100. I may make 150, but it adds up, and that's what we're looking at, is just it constantly adding up, and that we're not losing money over the course of time, that we're making hopefully a lot more money than we are losing per trade. So whenever we do lose on a trade, it's just a small piece. It's not a major drawdown. Um, and so we'll see how it the market continues to do. Tomorrow will be very interesting, and I'll try and do a video tomorrow. If I'm not able to do it in the morning, which I probably won't, it'll be tomorrow evening, and I'll do an update as far as how I ended. But I'm gonna go ahead and close it down.